Imagine finding a forgotten box in your house. Inside that box is $20,000 in cash. You'd probably feel excited for a moment. $20,000 is a lot of money. But then imagine putting that money back in the box and leaving it there for the next 10 years. Now let me ask you a question. Would that money still be worth the same after a decade? Most people instinctively say yes. After all, $20,000 is still $20,000. The number hasn't changed. But here's the uncomfortable truth. Even though the amount stayed the same, the value didn't. Because while your money was sitting still, everything else kept moving. Prices increased, housing became more expensive, groceries cost more, gas cost more, healthcare cost more. In other words, your money slowly lost purchasing power without you even noticing. And that's exactly what's happening to millions of people right now. They're working hard, they're saving money, they're avoiding debt, they're doing everything they were told was financially responsible, yet somehow they still feel like they're falling behind. Why? Because nobody explained the difference between saving money and growing money. And understanding that difference can completely change your financial future. Let's start with something that sounds strange at first. The safest place for your money isn't always the safest place for your future. Think about that for a second. Most people keep every extra dollar in a savings account because it feels secure. They can open their banking app and see the balance. The money doesn't move, it doesn't fluctuate, it doesn't create stress. That certainty feels comfortable. But comfort and growth rarely happen in the same place. Imagine two friends. Both start with $10,000. The first friend keeps the money sitting in cash for 20 years. The second friend invests gradually into diversified long-term investments. Now neither person becomes rich overnight, neither discovers a secret strategy, neither takes crazy risks. But over time, something interesting happens. The gap between them starts getting bigger, then dramatically bigger. Not because one person worked harder, not because one person's money was working while the other's was waiting. And this is where many people get confused. They think investing is about getting rich quickly. It's not. Real investing is usually the opposite. It's about being patient enough to let time do the heavy lifting. The problem is that patience isn't exciting. Nobody makes viral videos about steady progress. Nobody brags about earning average market returns for 20 years. People talk about overnight success stories, but wealth is usually built quietly, one contribution at a time, 1 month at a time, 1 year at a time. Now you might be thinking, that sounds great, but investing still feels risky. That's completely normal. In fact, almost everyone feels that way at first. Because when you save money, the balance rarely moves downward. When you invest, it sometimes does. You might invest today and see your account lower next week. That feels uncomfortable. But here's what most beginners don't realize. Risk and volatility are not the same thing. Volatility means prices move. Risk means permanently losing money because of poor decisions or short-term thinking. The stock market has experienced crashes, corrections, and periods of uncertainty throughout history. Yet long-term investors who stayed invested were often rewarded for their patience. The key word there is long-term. Not days, not weeks, not even months, years. And that's where many people make a mistake. They invest with a long-term goal but watch their account with a short-term mindset. That's like planting a tree and digging it up every week to check if the roots are growing. Growth takes time. Now let's talk about a simple approach. Before investing anything, build a financial safety net. Have money available for emergencies. Unexpected expenses don't schedule appointments. Cars break down, medical bills happens. Life happens. A safety net protects you from needing to sell investments at the worst possible moment. Once that foundation exists, start small. Not because small amounts create huge profits immediately, but because small amounts build confidence. Investing isn't just a money skill, it's a behavior skill. The habit matters more than the amount in the beginning. Then focus on simplicity. Many beginners assume successful investing requires predicting markets, finding hidden opportunities, or constantly buying and selling. In reality, complexity often creates mistakes. Simple, diversified, long-term investing has helped countless people build wealth over time. And while that approach sounds boring, boring is often profitable. Because boring keeps you consistent, and consistency is where the magic happens. Imagine investing the same amount every month regardless of what headlines say. When markets are high, you invest. When markets are low, you invest. When experts are optimistic, you invest. When experts are panicking, you invest. Over time, that discipline removes emotion from the process, and emotion is responsible for many financial mistakes. The people who succeed aren't always the people with the highest incomes. Often they're the people who stayed consistent long enough for compounding to work. That's the part most people underestimate. Compounding doesn't look impressive in the beginning. For years, it can seem slow. Then eventually, the growth starts accelerating, and suddenly the results look extraordinary. But what you're seeing isn't magic. You're seeing years of patience finally becoming visible. So here's the big takeaway: saving money is important. It's the foundation, it's the protection, it's the first step. But if you want your money to create more opportunities, more choices, and more freedom in the future, eventually it needs a chance to grow. Because the goal isn't just to earn money, the goal is to build a system where your money starts working alongside you. And the sooner you understand that difference, the sooner you stop trading years of effort for results that could have been much bigger. That's when financial progress starts feeling less like a struggle and more like momentum.